Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And a little bit of a different format today. We're doing a viewer request. And so we're going to be talking about FISV, which is an important fintech company that I have had my eye on, and I'm going to talk about that today. It was prompted by a comment left by the YouTube audience. So, our investment formula here at Crassus, if we're talking about the opportunities that we put into the portfolio on eToro, we want businesses that have low debt, margin of safety, sales growth, strong margins, free cash flow growth in particular, and share buybacks. In the current environment, that free cash flow conversion seems to be the deciding factor between some of the stocks that are being sold off and some that are retaining or increasing their market value during this heightened degree of uncertainty that the market's experiencing. If you haven't already liked and subscribed, if you could do me a huge favor and click the like or subscribe button, I would really appreciate that. And so here's the comment. Fahd Al-Shamari commented, "Good job, man. Liked your review. Would love to see your review in FISV in fintech." And yeah, it was coincidence that I have been keeping my eye on FISV, and the reason being is that Crassus, we are underweight the financials, and that's because it's not a great environment for traditional financials such as insurance companies and banks. We do own Allstate, which has a more diversified portfolio in private equity outside of their short-term cash and cash equivalents, so short-term treasuries and things like that. We think that they might be in for some headwinds. The market is pricing in some rate hikes, and so what happens if you're an insurance company and you receive premiums, you go and you buy short-term US treasuries or bonds of your particular government. And so if you start to experience a heightened inflationary environment, which we're beginning to, then the value of holding onto cash diminishes, and so the price of those bonds starts to fall and their yields or interest rates rise, and that has a flow-on effect throughout the economy because banks will borrow short and lend long. So they'll borrow overnight rates, short-term rates from central banks and governments, and so what happens then is they'll lend it out to you and I on a 30-year mortgage, and if they're borrowing the money at, call it 0.1% in Australia, that's what you're getting at the moment. The RBA has kept the funds rate at 10 basis points, and you're paying, we just bought a new house, and so you're paying around about 3% for owner occupied. So you can see that the banks are borrowing short and they're lending long over the life of the loan. So the question is, okay, well, how do I diversify exposure a little bit in terms of having some exposure to the financial sector in addition to Allstate, that doesn't put us at risk of the fragility of the banking business model? Meaning, if banks start to lend out at long fixed rates and inflation is above that, the real return that the bank is making over time is actually a negative. And so fintech is an interesting space. I'm going to talk about why I decided to go into that space as opposed to traditional banking, and why FISV seems to be a good candidate to satisfy that criteria. So some quick facts on the company. Revenue is 16 billion and 7 billion expected of EBITDA to come in at the end of this year. Great performance over the last 5 years. 21% CAGR on the top line is no small feat, and 24% of the EBITDA growth is a very, very impressive stat for sure, especially when you're considering that there is some margin expansion happening. Market cap at the time of recording, $72.7 billion US dollars. Enterprise value, $93.7 billion. The price currently is $109.84. 662 million shares outstanding. A big repurchase last year, which is always good to see. As you know, a huge fan of share buybacks for everything that indicates. $1.5 billion worth, which worked out at an average price of around $100. I roughly calculated last year was around 2% of the float reduced, which is excellent. Return on capital is about 15% over the last 5 years as an average. So that's very good. Net debt to EBITDA looks high at 3.5 times. So the question is, okay, do we have a good enough justification as to why we are going long this business when we're starting to push the limits a little bit in terms of debt coverage? And there is a good reason. If you look at it here, you've got last year they chose to take 1.5 billion in earnings and buy back their own stock. They could have chosen to pay down the debt. So the ability to service the debt is there. We wouldn't want to see it get any higher than that, but we're reasonably comfortable given the other fundamentals of this business that they can in fact service the repayments. And at the end of the day, that's the number one factor. Okay, Fintech company, as I've already displayed, they are a point of sale payment solutions and digital banking platform, and they're more to do with the payment side of things. So if you go to your local coffee shop, and they have an Android setup where they can process the payments for the coffees, and you'll see it on a little tablet, and it makes it very easy for the merchant to take all sorts of different payments, and very portable and a really easy to use platform. But they are fully integrated. They've got an acquisition of Clover, which has led to them really opening up and increasing their market share. So think about it. You would have no doubt heard of Square. You see the little white square, and sometimes certain vendors use it. You go and you just tap the square and bang, the transaction's done. Stripe obviously is a very popular internet platform. This is, excuse me, springtime. This is very similar to these two competing products. However, they are very fast, very easy to set up. So if I wanted to set up an internet business, I could have Stripe as my platform, and I'd be up and running within a day. It takes a little bit longer for FISV because they're more thorough in terms of the vetting their customers, and so they have a lower attrition rate over time. So it takes more hoops for you to jump through as a participating merchant to become a customer, but you tend to see the churn rate over time is far less than Square or Stripe. Again, more acquisitions. So First Data is another one. Increasing the cash flows and decreased costs are expected due to the synergy. So I really like that. They're looking to increase their market share via good acquisitions. Bad acquisitions always have a way of blowing up. But if you do have an appropriate target and you can use that to create cost synergies in the new consolidated entity, it is a favorite play of mine. It's a reopening play in the financial sector. So we've got a few reopening plays. We're very heavily weighted towards energy, which has worked out very well, but I believe it's going to work out far more so over the next year and even into 2023. I do not believe the market is accurately understanding the pressures that are being felt all around the world in terms of energy prices. So the question is, can we get in on another reopening play that's very low risk and high reward? We're expecting inflation. We're seeing inflation in basically all markets around the world. And so if you think about it, the way this company earns their main sources of revenue are from commission fees on those transactions. So think of it like Visa or Mastercard. You use your Visa card, and the merchant gets paid up front, and then Visa organizes the balance of payments, and they charge a fee for that. And so they can make money in two ways: from the amount of transactions that are occurring and the dollar value of those transactions, because they're taking a percentage of the transaction. So if you have 1% of $100, that's obviously more than 1% of a $50 transaction. And that's an exaggerated example, but that will help you to imagine each time that a business using FISV increases their prices, FISV takes a percentage, so they clip the ticket on that new higher transaction, and so automatically they have an increase in revenues. As we see people start to get out and about and normalize their spending habits outdoors or at bricks and mortar businesses, you are seeing obviously a greater velocity of money. People are buying more, and so you have that nice little mix from FISV's perspective of more transactions at a higher dollar value, and so their percentage fees are going to rise. So rather than banks that do have a fragile business model, this is a company that's in the financial sector, but it is not in the strict sense fragile, in the sense that as inflation starts to pick up, this company will do better rather than worse in terms of their returns. Let's take a look at some price action. So over the last 5 years, this is what we're looking at. So a very steady increase in terms of the price action. The market has recognized and rewarded the performance over the last 5 years, and they seem to be doing a very reliable job in terms of growing their earnings. If we take a look over the last year, this is of particular interest in terms of how we are able to get in at what I believe is a potentially rewarding opportunity from price levels of today. So over the last year, you just look at the volatility. The price has been all over the shop, and there are some good reasons for that. So as I've highlighted here, early this year, you would remember the GameStop fiasco that was making headlines, and even non-financial people were talking to me about GameStop and short selling and short squeezes and gamma squeezes and all this sort of thing. And so what happened in a nutshell is Melvin Capital was a firm, an investment firm that had shorted GameStop stock. And so then when you had all these Reddit users purchasing shares and bidding up the price as the short started to cover, they lost, I believe, in the billions. And so when that happens, a lot of these firms are trading on leverage, on margin. And so when you start to have your mark-to-market book value of your entire firm is going down every day, you have to sell. You'll get liquidation orders from your margin clerk. And so in that scenario, you don't sell what you want to sell, you sell what you can sell. Imagine if you have a mortgage on your house and then interest rates go through the roof and the house price plummets. You don't want to sell other things, but you might have to sell your car and your barbecue or whatever you've got. You sell whatever you can do in order to try and save your house by making those monthly payments. And that's what happened in this scenario. So you can see it absolutely fell off a cliff, strong recovery, and then fell off a cliff again. And so we're getting this a high degree of volatility over the year. And so if you draw that line, we're able to get FISV today at, historically speaking at least, a reasonable price. We're certainly not in at the yearly highs, and we're not far off the lows from 103, call it $103 to 109.84 is certainly not a large gap by any means. Okay. As I mentioned, Crassus is underweight in the financial sector. There's been good reasons for that, because I haven't been able to really find anything that took my fancy from a macro perspective. I think the financials are in a precarious position unless, if and when interest rates start to rise, I think that we could be in for a little bit of hurt. If you look down here, this is just me practicing a bit of the dark arts. I've grouped the sectors and had a look at a very rough valuation metrics, the price to earnings for each of the sectors. So they take the average of all the companies in a given sector, average them up and say this is the average PE for the sector. It's a very crude metric, but it's a good place to start in terms of choosing a sector, and then I like to go into the sector and work out the best opportunities in that given sector. So if we look at a forward PE ratio, financials there at about traditional fair value compared to the S&P 500, not the S&P of today, but historically speaking, that's about fair value. And so I look at energy, we're nearly 15% of the fund allocated. Materials were very heavily allocated, and healthcare. They have inelastic demand and a very have inbuilt hedges against inflation. So the next question is, okay, well, if we look forward into the expected growth rate, we would expect financials to be doing quite well according to this chart. And so I need to just sort of round that out and even allocate 1 or 2% more of the fund towards the financial sector, and that will give us more diversification. If we look at revenue and EBITDA margins over the last 5 years, as you can see, black column here has done really well. Okay, more than triple the top line revenue over the last call it nearly 5 years worth, which is sensational. If we look at the margins, they have not really sacrificed their margins in terms of getting this new growth, and that's fantastic. Sometimes you can see a company go and buy a whole lot of other businesses or invest in a heap of capex, and it makes their sales look good because their top line revenues have increased, but they're not keeping much at all in terms of actual profit. Their margins start to diminish as opposed to expand. These guys have basically kept their margins static and grown, and they've increased their top line revenue by a long way. So that's a really good feather in the cap of management. And so if they can keep that up over the next 5-year period, shareholders should do very well indeed. Here's a what-if scenario. I don't know if this will occur, obviously, but from a back of an envelope standpoint, I'm taking a step back and looking at this business and say, okay, well, what's their top-line sales going to be? Their margins are very predictable and reliable, so we think that we can add those in without too much of a drama. The question is, what will the market pay for this business in terms of a multiple in 2022, 2023, and so on? So if you just say, okay, look, we're expecting to get about 7 billion EBITDA for 2022, and you can work that out via projected sales and those margins. What would happen if you valued this business on the same multiple as Visa or Mastercard? Okay, because that's essentially what this business is. They're taking a clip on all these transactions. If that were to occur, we're looking at a target price of $265, which from today's price is nearly 2.5 times the upside. So again, I'm not saying that will happen, but that could be a really bullish scenario that it certainly doesn't have a zero chance of happening. There is a chance that the market could re-rate and look at this business and say, well, actually, we think it's worth 25 times enterprise value to EBITDA that it's producing. So there's the rough back of the envelope calculation, just to keep in mind. However, if we drill down and take a much more reliable, much more conservative approach, this is what we end up with. So as I always do, I take the free cash flow, the EBITDA, and the earnings, okay, in the left-hand column, and we apply either historic or industry median multiples, okay? So this is a much more reasonable multiple to expect into the future. So it's basically what the company is trading at today, and so a little bit higher, so closer towards the industry median, but not by much. If you were to have this projection play out next year, towards the end of next year, in terms of the free cash flow, the EBITDA, and the earnings, and the market were to value the business at the multiples in the middle column, these would be the implied prices in the furthest column on the right. And so if you average those equally, which if you look, there's quite a large difference between the earnings and the implied price. We're looking at a 33% upside, and over 12 months with low interest rates, pretty safe to say that's a 33% IRR, which is an excellent return and fairly low risk. I mean, this would be, I would say, more of the modest to base cases, whereas the bullish scenario that I presented before, yes, that does rely on a lot of exuberance from the market, but hey, you've seen some of the things that have been going on in the market. People are paying ridiculous amounts of money for meme stocks and coins that no one knows what they are or what they do. So it's not unreasonable to suggest that perhaps then some of that capital will start to look towards actual businesses that have actual real operations and have actual real profits. I mean, what a crazy thought. It could happen. It could happen, guys. Okay. So if we project out a little bit further over the next decade at today's prices, using historic growth rates and the median multiples that I mentioned before, discount those cash flows at a rate of 6%, which is the working average cost of capital for the company, we'd expect an IRR, if all that plays true, at 26.74%, which is very good. Okay, you're not going to complain too many times in histories if you can get an IRR of that magnitude. Okay. And that was for the EBITDA. This is the same principle, but just using the cash flow inputs, okay? And so if we discounted the cost of capital, here we've got 23.68% as an IRR. So expected returns on this company are very, very good. The downsides, in my opinion, are relatively limited. Perhaps sales slow and they can no longer buy back as much of their float as they wanted to, and so therefore they have to be conservative and pay down debt, so shareholders start to re-rate the shares. It could happen, but I think if you're looking for a play in the financial space, as I am, and I think fintech makes a lot of sense as opposed to just a straight play on the banking sector, but that's just me. As we so often do, we plug in a base case, a bull case, and a bear case using earnings, free cash flow, and EV to EBITDA over a decade, okay, a 10-year time frame, and assign probability weightings to each. And to cut a long story short, we get an average intrinsic value of $143.76. So if you're not familiar, I use a discount rate of 20% when doing this, and the reason is that's what I would like as a minimum return as an investor, to take the risk of entering into the publicly traded markets. So for us to get a return of 20% year on an annualized basis, we can pay $143.76 and no more. Okay. Obviously, if we buy it at a lower price and all else plays out as we expect, we're going to get a higher rate of return. If you look at a margin of safety, what we're saying here is, can we buy the stock at 2/3 the value? Okay, so 2/3 of that intrinsic value. And so if the stock starts to drop around the $95 mark, I'll start to add to the position, because that's giving us an increased margin of safety. Pretty straightforward, nice, simple business, which in my opinion are always the best. So the verdict is it's a buy. It does have low enough debt given the serviceability, but I wouldn't say it has low debt on aggregate. Has a margin of safety, sales growth, strong margins, free cash flow growth, and a history of share buyback. So if that can continue into the future, then I think this company is set for a reasonably bright short-term future in the midst of a lot of turmoil. So the stock starts to get sold off, particularly if it drops below $95. I'll be interested in scaling in and adding to the position. Given our big position in Allstate, we'll probably look to add maybe 1% of assets under management to FISV, maybe a little bit more if the stock really tanks and we see more value as a result. Thanks for watching. If you haven't already checked out the portfolio on eToro, click the link. You can add us to a watch list, and you can copy yourself if you've got funds ready to invest. And if you haven't already pressed like and subscribe to YouTube, I greatly appreciate you doing that. Helps me get the word out there. Or, as always, the disclaimer, I'm not your financial advisor. I have no idea who you are potentially watching this video. So make sure you take responsibility for your own decisions. What I say is not advice. It's just what I'm doing and what I'm thinking. I can be wrong, and as can anyone. And so you need to take that into account. Don't make decisions necessarily based on anything that I say. This is just for entertainment, informational purposes, to say what I'm doing personally and with the fund and how that's all tracking. As always, you need to be responsible. So make sure you take that seriously, guys. And as always, have a great day. I'll be back with another video. If you've got something that you would like me to review, just leave it in the comment section, much like Fad did, and I'll get back to you as soon as I can. But the list is growing, guys, so you're going to have to bear with me.